Good evening, everybody. Nice winter evening here in Pittsburgh. All right, tonight we've got the great pleasure of having Chris Verhaegh back with us. Quick background of Chris. He read well over 100 weekly columns for OptionInvestor.com. He's been doing workshops for Invest Tools and has been producing technical analysis for fund managers and helped trade over $2 billion. But tonight he's going to kind of give us the inside techniques for trading weekly options. So Chris, welcome back to the Candlestick Forum. We're anxious to hear your information tonight.
Stephen, thank you so much for having me. It's a pleasure and an honor. So with your permission, I'm just going to get right into it. First of all, I'd like to thank each and everyone for being here tonight. I'd also like to thank anybody that's listening to a recording of this. Couple things. I'm more than happy to answer questions. I tend to answer all my questions at the end. I found that while giving presentations, a lot of very insightful traders out there, they're asking a question that if it's not the very next slide away, it's just 2 or 3 slides out. So having said that, I'm going to get right into it. I entitled this presentation, Trading Weekly Options, Using Math to Generate Fantastic Short-Term Trading Profits. For me, I define math as basically arithmetic, addition, subtraction, multiplication, and division. I think you'll agree with me what I'm about to show you is fantastic, and I think you'll agree that it's short-term. Having said that, before I talk about how to make money or the fantastic profits, it's bottom line, it's as simple as this. You got to just buy low, sell high. Buy low, sell high. Don't forget that. Theoretically, I can end the seminar right now if it was just me telling you how to make money. I'm going to try and give you more specific things to make money. Understand, in this brief period of time, I can't teach you everything. I'm sure everybody's going to learn something tonight. Having said that, I always have to start off with the lawyers. All securities used in this presentation are for educational purposes and are not to be construed as a recommendation to buy, sell, trade any of these securities. I will be talking about real stocks. I'm not going to be talking about stock XYZ or ABC. We talk about real stocks. Actually, we talk about options on real stocks. And you can't talk about options without talking about stocks. And I trade a fair amount of stock personally. The one thing about stocks is it's one-dimensional. It's price, right? Again, buy low, sell high. You theoretically could do it in any order, sell high and buy low later. But that has a lot of risks. And what we try and do is make money without taking on excess risk. And we do that through the use of options. Now, options are multi-dimensional. They take into consideration not only the stock's price, but its previous price, right? Its historic volatility. An option's a fixed time investment. It's only good for so long, so it takes into consideration the amount of time before that option expires. It takes into consideration interest rate and dividend, right? And it takes into consideration the expected future movement. And we can profit off this formula. Like historically, option traders have looked at options as a stock substitute. I want you to think of options in and of themselves. Understand, with options, there are reasons to trade options, right? How much do you use and how much could you lose? Historically, people had bought options because you're using less money. And I'm going to tell you, we're going to use very, very little money. And with an option, unlike a futures contract where you're taking on excess risk, leveraged risk to get a leveraged return, we get a leveraged return with options without leveraging our risk. Now, again, historically, people have looked at options as a leveraged directional play. If you think a stock's going up, right, you buy an option on it instead of buying the stock. The beauty of options, you can play it both directions. If you think it's going down, instead of shorting the stock, you can buy an option. Now, I'm going to make the assumption that many people on the webinar tonight already know the different types of options. And having said that, what I'm about to show you might be a yeah, duh to many of you. I apologize if this is yeah, duh. I don't want to leave anybody behind, so I'm going to tell you that we're going to get into some option basics. And if this is new to you, I apologize, but this is about as basic as we're going to get on options. There are two types of options. There's a call option and a put option. Call option gives the buyer of that option the right to buy the stock at a set price for a set period of time without the obligation to buy. Right? They control the stock. The right to buy for a set period of time, that's until the option expires. Right, option has an expiration. At a set price, that set price is known as a strike price. Right, a call option can be considered a bet that the stock is going up in price. Right? When you buy stock, you make money one-dimensionally if that stock goes up in price. With a call option, you make money if that stock goes up in price. The second type of option is a put option. Now, a put option gives the buyer the right to sell a stock without obligation. The buyer of a put option has the right to sell a stock without the obligation, right? The right to sell at a set time or at a set price before a set time. And a put option can be considered a bet that the stock is going down in price. Now, additionally, a put option can be considered an insurance policy. If you own a stock, you can buy a put on that stock. So if the stock crashes in price, you can put it to somebody, right? We are not going to be looking at put options as insurance. We're going to be looking at it as a way to make money on stocks going down. Understand there are probably 10, 12,000 stocks out there, but only a quarter of them or so have options, right? And we need to find the best one. We're not going to trade every stock. It should not be someone's life goal to trade every stock listed. You know, it's not your bucket list to trade 12,000 different stocks, right? Your bucket list should be to make $12,000 over and over again, not to trade 12,000 stocks. So what we do, we use options to help us reject and to focus on a few. So we start with the large universe as we whittle that list down, right? The first whittle is if it doesn't have an option, we don't even consider it. Next, we want options that have an expiration every week, not every month, right? These are weekly options. There's about 300 or so stocks that have weekly options. So we've whittled the list down from 10, 12,000 down to 300. Now what we do is we use some math to get that list down from 300 to a few dozen. And the way I do it is through my pulse system. Now understand, pulse is an acrostic, right? An acrostic is an acronym on steroids. It's an acronym that spells something, right? It's also a memory tool. I try and help students learn to become better traders, right? I help traders become better traders by educating them. And I think the best way to educate is to learn something and have it stick with you. And I've found that this sticks with people, right? You want to trade for the rest of your life. You want to start off early, start off right, and one way to do it is a memory tool. So PULSE stands for something. P is profit potential. U is upside reward. L is low risk. S is setups and strategies. E is events, entries, and exits. I've combined my methodology, my pulse system, into a pulse system to learn how to trade, right? I've written a book. I've filmed videos. I write a weekly newsletter. It comes out every weekend. On that newsletter, I share the watch list, right? These are the dozens of stocks that have the best math. I've rejected thousands and thousands of stocks to get it down to a short list for you. Of that short list, I find 5, give or take, each week that have some sort of setup, some sort of reason to be considered more important than the others. And each week I write about these, and each week we review what I wrote about the week before. Right? I say that the emperor has no clothes. When I pick stocks, I can't hide. I understand if I were a guru, come on here and I say, hey, look, I'm the best stock picker. I've got this great track record. Every pick I've made in the last 10 years is hit, but it takes 5 or 6 years for them to hit. You wouldn't know for 5 or 6 years, right? You're going to know in 7 days whether I was right or not, right? Sometimes less than 7 days if I make a prediction for something early in the week. We always review it, and then we're constantly always educating. Having said that, let's get into the actual system, right? P is potential profit, right? P can also be for profit potential, right? We want upside. Here's a screenshot from June of last year of some Amazon call options. I've got a red highlighted box on the left. This is the opening price for the day. The red highlighted box on the right is the high price for the day. Understand, the high came after the open, right? And so I want to prove to you that this is both fantastic and short-term. I say short-term because it's all in one day. I say it's fantastic because you have options here that went from under 50 cents to over $13, right? Under a quarter to over $10. The 320 call went from a dime to $8.95. Understand that an option contract controls 100 shares, and so the 320 call that opened at a dime would cost $10 per contract, and the high of the day was $8.95 or $895 a contract. I want you to know that short term, one day, fantastic, from $10 to $895. And while there's a variance between these, they all moved up a minimum of a triple. And this is Amazon from June. These are Amazon call options. A week later, Amazon moved back down, and we had the put options moving up. Again, we have options that moved from less than 50 cents a share, less than 25 cents a share, some for less than a dime a share, and they made moves of 300% to 500% in one day. I think you have to agree that is profit potential. Here we have a chart on a VXX call option, right? Now this VXX call option, this was back in August of last year. Now, let me tell you, if you want, you can go look up VXX today, right? I think the 30.5 put for today opened at a penny and traded to 14 cents. Right? The 31 and 31.5 put had moves of about 500 or 600%. This move here, we have a low of 8 cents moving to $1.90. In the right, we have the 29 call that opened at 2 cents that hit $1.50. Right? This is profit potential. When you can buy something for $2 and sell it for $150 later that same day. Now, those are not typical. And to me, people ask me all the time, say, Chris, how well do you do at this? I'm going to tell you today's, February 12th? I'm probably up $30,000 trading this year, right? In 5 or 6 weeks, 6 or 7 weeks, I'm up $30,000. Hey, that's great. But it doesn't matter what I do. Right? I'd like to extrapolate that. I'd like to make maybe $250,000 this year trading. Maybe it gets slow in summer. I only make $100,000. Doesn't matter what I do. It's what my students, what they do that counts, because if you want to compare yourself, you want to compare yourself to a contemporary. You want to compare yourself to another student as opposed to comparing to me. So here's a student's trade. This is from a year ago. He bought the Tesla call options, right? This was, bought them at 60 cents a contract. He bought 20 contracts at 60 cents a contract. That's $1,200. Later that same day, he sold them for $7.30, right? Which is $14,600. He made $13,400 in one day. Same student, right? Same student bought the FCX option at 4 cents. He actually bought this exact option here. He bought it at 4 cents and he sold it at 32 cents. Right? I don't know how many he bought, but from 4 cents to 32 cents, that's an 800% move in a day. Now here's this slide. I want you to look at very carefully. This slide was taken November 7th, 2013. Now you might say, Chris, that's a long time ago. One of the reasons I keep this slide, besides the fact that it's the same student that hit on Tesla, is that this very next slide is also from November 7th, but 2014, right? It's an FCX trade. This one didn't do so well. It went from 8 cents, right, at the open, closing at 32 cents. So it only moved 400% in one day. I got to tell you something. We hit FCX regularly, not necessarily week after week, but month after month. We get hits on FCX. We have a system to trade FCX options, right? We tend to look for options that are just under a dime, slightly out of the money, and we get a big move. You can back test this on your own, and I encourage you to test what we do. Again, when I write the newsletter, the emperor wears no clothes. I cannot hide if and when I make mistakes, but we also know fairly soon when I'm right. Now those are some fairly things, right? 400% on FCX, 800% on FCX, making $13,000 on Tesla. This is a more typical trade, right? And this is an actual email from a student. He says, great call on your updates. Now he's referring to me picking in my top 5 these stocks. This is Chipotle Mexican Grill and FAS. He says at 9:35 a.m. Eastern, I bought 10 contracts of the Chipotle Mexican Grill, January week 4, $500 puts for $1.95. Couple of things. The market opens at 9:30, right? So he bought these 5 minutes after the market opened. He paid $1.95, which is $195 a contract. He bought 10 contracts, which adds up to $1,950. He paid $15.35 in commission. He also bought the FAS. That, if you're not familiar, that's the banking sector 3 times bullish tracking stock. He bought the puts for 35 cents. Again, 10 contracts. Since there's 100 shares per contract, that's $35 a contract. 10 contracts would be $350. Paid $15.35 in commission. He says, as the attached screenshot shows, I closed out both transactions for a one-day net gain of $6,538.44. He says, fantastic. I want you to agree, right? I want you to agree that since he called it fantastic, it's fantastic, but there should be no argument that since he did it in one day, it's short term. Right? Here is why it's typical. If you look closely at his entry and exit times, he bought these options at 5 minutes after the open and 6 minutes after the open, and he sold them both 4 minutes before the close. My point is, the way our system works, right? Most of our entries are near the open or near the close of the day, right? Near the open or near the close of the day, and or if the stock is at a particular price, and we have a formula that we teach it to. This is a typical email in that he bought 5 minutes after the open, right? And he sold just before the close. Here's probably a more typical email. Saying, I want to let you know I traded Salesforce.com today. It was on your list, right? That's the newsletter. He says, if my math is correct, I realized 500% on this trade. This was virtual trading. See attachment and make comments. I still have to watch 3 videos, right? Here's why I say this one's typical. The line there, this was virtual trading. He paper traded this. The beauty of this system, right, is that you can practice without real money, and you will know in a very short period of time if you've got it or not, right? If you don't have it yet, right, there's a bit of a learning curve. If you don't have it yet, don't use real money. Once you get it, switch from paper trading to real money. Right? I also think this is kind of typical that he dives in not having studied all the material yet. Again, here's his actual email. He bought it 16 cents and he sold it 96 cents. Anyway, P is profit potential. U is upside reward. Now, you might say profit potential and upside reward, they go hand in hand. Did you just use this one so you can have an acrostic that you spell something? And I want you to realize that while I show you many gains for many moves of 4, 5, 6, 7, 800%, many moves, I'm going to show you moves in the thousands of percent moves in a day. We look to make a minimum of 100% on our trades. That's our thing. If we don't feel a setup can make a minimum of 100%, we reject it. Right? And we do this while risking little amount of money. Right? We don't put huge amounts of money in a trade. We often will look at pennies per share. Right? I did give you the example of $1.95 on a Chipotle Mexican grill option. Understand Chipotle is $400 or $500, right? You're not often going to get an option for pennies on it, but we look for very inexpensive options, right? PUL is the first part of the pulse system. That's what gives us our short list, right? Where we take 12,000 stocks down to a couple dozen. I'm going to tell you, I've got a mathematical formula. I don't hide the formula from my students. I give you an Excel spreadsheet. You can go to Yahoo Finance. You can download historic data, plug it into the spreadsheet, and it will tell you whether the candidate is worth looking at or not. There's no secret sauce here. I'm more than happy to share, the math with my students. Once we've got our short list of stocks, we're going to look for a reason to trade it, right? We need a setup. Now, to me, the best is a stock-specific setup, right? A technical reason. And I think this is one reason why Stephen's students do so well. Right? I'll get a student send me an email and say, hey, using Steve's candlestick charting, I saw this doji or I saw this signal, and I knew it was the right time to trade options on that stock, a technical setup, right? I think part of what we teach you is which option to buy on that setup, right? And we also use S for strategies, right? We have directional and non-directional strategies. A directional strategy is if you have a technical signal and say, hey, this stock's more likely to go up, you want to buy a call, right? If you have a strategy or a setup that says, hey, this stock's more likely to go down, you're going to look to buy a put. But I want you to know our math is such that we find moves so big that you do not have to be right on direction. In those instances, we will look to buy a non-directional trade, either a straddle or a strangle. A straddle is a call and put with the same expiration with the same strike price. A straddle, right, is when we think a stock's going to move, we just don't know which way it's going to move. In that instance, we're making a bet that the stock will move. We can buy a strangle, which is a call and put with the same expiration but different strike prices. Understand, a strangle will have a put with a strike price below the stock's price and a call with a strike price above the stock price. Right? Strangles cost less than straddles, but you need a little bit bigger move to get somewhere. But if you get a big move, you make a ton of money, right? A ton of money. So a strangle is a non-directional bet a stock will break out. P-U-L-S-E. E is events, right? We can have a stock-specific event or a market-wide event. Last Friday was non-farm payroll report. Next Wednesday is the FOMC meeting minutes. These are market-wide events. A stock can have a stock-specific event, such as an earnings release, right? This is earnings season. Now, I got to tell you, we do not buy our options prior to the earnings release. Right? We do not buy our options prior to the earnings release because they're inflated. The market makers jack up the implied volatility, making the options incredibly expensive. We wait until after the earnings. So in my newsletter 2 weeks ago, I discussed LinkedIn and Twitter, right? I gave the reasons why those stocks were better candidates than others, right? And this is an email from a student, right? This is an actual student email. He bought 20 contracts of the $267.50 call on LinkedIn at 6:34 a.m. Now I'm going to tell you, he's in California, right? The market's open from 9:30 to 4 Eastern. What's open from 6:30 to 1 Pacific time. 4 minutes after the open, he bought these options for $1.45, and he sold them about 2 hours later for $4.55. Right? If you do quick math, he made $3.10 a contract times 20 contracts. He made $6,200 on that one trade. Right? Simultaneously, he bought 20 contracts of the Twitter 46.5 call. He paid 61 cents and sold them for $1.45. Right? This is an actual student's email from a week ago. Now, E is not only event, it's entry, time, and price. I shared with you, we look to get in quite often shortly after the market opens. Right? That's a time. We also look to get in at specific prices. As an example, right? We only buy straddles if and when a stock is equal, the stock price is equal to a strike price. Right? The strike price is what you have the right to buy or sell the stock at. We only buy our straddles when the stock price is equal to a strike price. So as the stock's bouncing around throughout the day, at some point in time during the day, its price might be equal to the strike price. That's when we enter. Right? It's, to me, fairly simple math. I got to tell you something. It's obvious to me, right? But besides the fact that I've created a system, right, after years, decades of experience trading, it will make sense to you, right? I say obvious is a function of familiarity. Once you become familiar with the system, applying it becomes obvious, right? The times to buy becomes obvious. Now, we don't buy anything unless we have an idea what we can sell it for, right? We're not just going to buy a stock or an option on a stock because it's 5 minutes after the open. We have to have an idea in our mind to target what we think we can get. And again, we don't like to buy anything unless we can at minimum double our money. Right? Does that mean we always double our money? No. But is it okay to make 30 or 40% in a day? Absolutely. And now you'll surprise yourself how often we can do 10 times better than that. But when we buy, we have a target in mind, and if we're able to, once we become profitable, we can put a stop order beneath our price, and as the option moves higher and higher, we can raise the stop with us, and therefore we can participate in more of the move. Again, PULSE is the pulse system, right? I've taught you the basics of it. Let me tell you a little bit about the pulse system, how we apply it. Again, in my newsletter, I have the top 5 plus or minus every week. There's been a week that it's been only 1 or 2 options, right? I think we probably had 5 or about 7 of them, 7 stocks or so in this week's newsletter, right? And besides passing the math, I will write something about them. Right? I'll give a reason to trade it. So this is from November, back when I said, if Tesla gaps up, this is quote word for word out of the newsletter, right? This was in regards to an earnings release. And I said, if Tesla gaps up, I feel the reversal has a higher likelihood of being the better trade. Basically, if Tesla gaps up on earnings, it's not going to hold, it's going to go back down. I said, if Tesla gaps down, I feel the continuation has the better chance, right? Basically, if it gapped lower, it was going to go lower. I said, I feel the continuation has the better chance. Both involve buying the puts. As always, you can hedge yourself by buying a strangle, right? Both the call and put. So Emperor has no close. In November 2nd, I said, here's what I feel Tesla's going to, react to the earnings, and here's how you trade it. So here's an email testimonial I got 5 days later. So it's Thursday at 9:39 a.m., right? Again, this is less than 10 minutes after the open. That's kind of how our system works. It says I bought 5 of the 143, right, the $143 puts on Tesla at 42 cents. I then placed an order to sell at $1.50. That's a target order. That's what he was satisfied with, just a little more than tripling his money or tripling it after commissions. He says, I left. 2 minutes later, he was filled. Said, you suggested puts no matter where it opened, and it worked. Another email, different student. Day later. As a newer student of 3 or 4 months, I had a great week trading your system. Says, I bought 1 Tesla, $149 put for $1.38, and I sold it for $6, right? He put $138 and pulled out $600. The previous student, right, buying 5 contracts at 42 cents, he put in $210 and he pulled out $750. Right? Both these students made money. Now I'm going to tell you, if both these students didn't follow my advice exactly and buy just a put, if they weren't so sure and they bought a put and a call, the call can't ever lose more than it cost. And our system has us buying a call when it's roughly the same price as a put. So in reality, their profits would have been just cut in half. Right? Now, these guys made pretty decent money, but they left some money on the table. And this is one thing I try and teach. We find moves that are so big, you don't have to get all of the move. Right? You don't have to get all of the move. We call it sloppy slop, right? These 2 students were sloppy. First student bought for 42 cents, sold 2 minutes later. Again, you can't argue that 2 minutes is short term. You might argue that going from $210 to $750 is not fantastic, but you can't argue that 2 minutes is short term, right? Here's a chart of his trade. In the lower left is his actual trade. He bought for 42 cents and sold for $1.50. If he would have held for 2 more days, he could have sold it for more than $10. He left money on the table, right? And this, by the way, this is November of 2013 on Tesla. Again, I want you to double check everything I tell you. Right? Tesla just released its earnings today, so Tesla gapped and reversed, and the call options made a fair amount of money. Right? Tesla gapped down, but people that bought the calls after the gap, they could have made money today. Right? If the person bought the calls and puts, the calls could have made more money than the puts would have lost them. All right, so we have the Pulse system, which is the book. The book gives you an understanding of how it works. Right? The video goes more in depth. Some people learn better by reading. Some people learn better by watching and listening. Every week I write a newsletter. The newsletter's got the watch list, right? This is the few dozen stocks that have the best math. The top 5 are the stocks from that watch list that have a reason to buy them, right? And I write, 2 or 3 paragraphs, 2 or 3 pages, whatever it takes to share the reason to consider buying options on that particular stock. As always, review the previous week's pick, and we're always educating. Our goal is to teach you how to exploit a setup, right? To exploit a setup. So one of the things we do, right, I have a joke, who's the best stock trader ever? And most people say, probably Warren Buffett. I say, he's probably the best stock investor ever, but, there's a couple guys that maybe don't have as much money as him, but maybe get a better percentage than him. But I think the best stock trader ever was a guy by the name of Noah Finder, right? Noah Finder. Know a stock, find a strategy to trade it, right? Know a strategy, find a stock to match it. So in knowing a stock, one of the stocks that I've been trading for years and years is Schlumberger. The ticker is SLB, right? SLB. So here's June of 2014, right? Understand a couple of things. I want you to understand weekly options did not exist until June of 2010, right? I don't need to give examples from prior to that because we don't have weekly options, right? And I have, examples from 2013. I got examples from 2014. I got examples from 2015. Right? The LinkedIn example from a week ago. Part of what I want to show you when I show you an old stock, an example of an old move, is to show you the continuous of this, right? To show you the fact that if you know Schlumberger, right? If you know Schlumberger, it's like a rental property where you get to collect a rent, right? It gives you a paycheck, month after month, year after year, right? In many instances, week after week. Schlumberger, in June of this year, we had a 1,300% move, right? 1,300% move. A couple weeks later, right? A couple weeks later, here, this move's only 1,000%, right? And this move, what I like about this slide here is the highlighted red box to the left shows the close on one day at 7 cents, shows the open, right, on this day at 7 cents, which kind of backs up what I say, that we buy near the close of one day or we buy near the open of a day, right? The high is 70 cents. That's a 10 times move. Now, right above where it's previous and closed, you'll see that this option closed at 20 cents, right? This option closed at 20 cents. So someone could say, well, hey, there's a big give back there. And my answer is that by using a stop loss, right, we will not capture the top of it, right? We'll be a little bit sloppy, but we'll get most of the move. A week later, again, look at the close, look at the open, 13 cents, 12 cents. This opened, right, at 12 cents, went up to $4.36, closed at $3.90. Again, the open to the high is 33 times in price. It's 2,900% move overnight. Here's an email from a student. It says, thanks, Chris. I got in Slav early this morning and got out with $1,000 profit in 15 minutes with 10 contracts. I enjoyed your service very much. Too bad I'm not a day trader. Thanks again, TAK. Couple things. You might not agree that $1,000 is fantastic, but I'd like to think that everybody cannot argue that 15 minutes is short term, right? I have this student's email because it brings up a point. He says, I'm not a day trader, right? I'm not a day trader. And there's concern. I get people saying, hey, look, I don't have $25,000 in my account. This sounds like being a day trader. A couple things. A lot of those examples I show you getting in on one day and getting in on the close of one day and getting out the next day, that's not a day trade when it's overnight. Additionally, small accounts are allowed a minimal amount of day trades, right? So you got to kind of self-police yourself. I promise you, I will give you more opportunities than you can trade. Having said that as well, I'm into the minutia of details, right? The day trading regulations are specifically for margin accounts. The federal government says, we don't want you to go out and borrow money, put on leverage, get in and out, do that over and over again because you're going to lose eventually and you're going to owe more, right, than you had money for. Well, two things. Options can't be margined. You have to pay for them in full, right? They settle the same day. You don't have 3 days to pay for them. So you do not need a margin account to trade options. You can open a cash account with some brokers for as low as a couple $100 and trade and set up as a cash account, not a margin account, and you can day trade all you want. So, a couple things here. Schlumberger, same stock again. This is October. Again, here's a great example of overnight. It closed at 40 cents on one day, opened the next day at $3, went up to $4.35. That's tenfold in price. That is not a day trade. Now, same night, Schlumberger. This one went from $1.25 to $2.80 overnight. Different strike price, same day, 16 cents to $2.24 overnight. Right? Part of our system, you do not have to pick the exact right option. When we have rules on which option you buy. Certain stocks, here in this instance, Schlumberger's in the mid-90s, right? And their strike price is every dollar that I'm giving an example of. Since then, the exchanges now have strike prices every 50 cents on Schlumberger. We give you a certain range. You just need to be in the area, and then you determine if you want to buy a 16-cent option or a 24-cent option or a 40-cent option, right? You determine what your risk is, how many contracts you buy, right? And it's going to vary from one trader to the next. Another email from a student, right? I call this sloppy slop, right? I think traders that trade Schlumberger, we're slob traders, right? It's a term of endearment. It's a name of affection. So I've been a student of yours for 4 months now, and yesterday, Friday, 10/17, I officially became a slob. I bought the 95 strike puts at 14 cents and simultaneously set an order to sell at 56 cents. Right? He bought him. He set a target to sell at 4 times his cost. Ran out to do some errands and get ready for a business webinar at noon. I picked up my trading account, and my sell to close order had been filled for a 333% profit in less than 2.5 hours. It says with sloppy slop, it got up to around 90 cents and it closed at 66 cents. Profitable, right? We are not going to catch all the moves. We just catch a big enough piece to be happy. Schlumberger, yet again, November, right? Closed at 9 cents, opened at a dime, went up to 87 cents. Another student email, trading slob strangle. Again, a strangle is a call and put, same expiration, different strike prices. The put is always lower than the call. It says, my newest, bestest buddy, I don't know if he was referring to me as his newest bestest buddy or if he was referring to Schlumberger as his newest bestest buddy. But once you learn to trade Schlumberger, you'll trade it for years. So I want to let you know one of your students rang the bell with a really nice game with Schlumberger. Felt some shivers of greed hitting me a bit, but felt making a double was enough to put a smile on my face heading into the weekend. Says I bought the Schlumberger 96.95 strangle, right? That's the 96 call, the 95 put, at around 1 p.m. yesterday. Purchased the calls for 50 cents and the puts for 58 cents. Right? In a perfect world, he would have paid 54 cents a piece. Right? Anyway, he paid $1.08 for the pair. Said he was able to sell the calls for $3.10 this morning and let the puts expire worthless. Right? $1.08 became $3.10. Far more than a double. This, right, I want you to know a couple things about this. People say, oh, options, I've heard that 85% of options expire worthless. I'm going to tell you something. It's probably closer to 50%. Because if the call's in the money, the put's out of the money. If the put's in the money, the call's in the money, right? So about half of them will expire worthless. So I have no problem if we have something that expires worthless. Because if we can make more than 100% on the other half of the trade, we make money. Now, real quick, I'm looking at the questions. I'm trying not to answer them because someone says, are these all earnings plays? Right? Schlumberger does not release earnings in October and November, right? It's every 3 months. Earnings are every 3 months. We trade Schlumberger probably 3 weeks out of the month. Right? And we trade earnings, but only after the earnings release, not before, because before the options are expensive. Another email from a student. I'd like to thank you for teaching me how to trade Schlumberger. Right? I've been trading it for almost 2 months with success. I'm up over $15,000 to date. I basically trade with strangles, and I'm amazed how consistent it works. I usually wait for the price to be between two strike prices. That's our rule, right? We enter when the stock for a straddle when the stock's at a strike price, for a strangle when it's between the strike prices. He wants to know if there's any other securities that trade similar to this. My answer is, does there need to be? Right? We can get some big hits on Schlumberger. Here's a week later again in November. 2 cents to $1. Right? This is late in the day. Not all our trades are so short, right? Or this was an Apple from 2013, right? I wrote in the newsletter, right? Here, the lowest box on the left shows Monday, Tuesday, Wednesday, and half a Thursday where you could have got in this option for 50 cents. It went up to over $7. Right? So you have lots of entry times. There's going to be a big variance between students. Some might get in at a quarter, some might get in at 35 cents, some at 45 cents. And then there's going to be a variance on exit. Right? Some people are going to be more sloppy than others. Right? My belief is that the system has a little bit of a learning curve. The more you do, the more the slop comes out and the better the trader you are. Right? Not all options are short-term. That same newsletter, I picked Apple options. I said, buy a long-term Apple options that are close to $3. Right? It's pretty simple. Buy the option that's close to $3. If someone says, raise their hand, what expiration? And my answer is, I don't care. Buy any expiration. Buy the option that's $3. And they say, what strike price? I say, I don't care. Buy the option that's about $3. Right? So I wrote that on a Saturday. Here on Monday, the options opened up. Here's a couple that opened up around $3, and by the end of the day, they were over $4. Hey, that's a great trade, 33% in one day. Well, guess what? It went to 20-some-odd dollars within a couple of weeks. Right? So I did not want to buy a long-term option. I did not want to buy a leap because we're going to get in and out in 30 minutes. Right? I wanted to buy a leap because I felt Apple was going to run. So, point is, when I write in the newsletter, while we focus on short-term trades, I often find long-term trades. Again, I have a system for doing this. I've written a book. I film lots of videos. Videos are somewhat similar to this, except I'm maybe not so rushed for time. Right? I take a little bit more time to go into more details. Right? I write a weekly newsletter. I'm a professional writer. Right? I've published hundreds of articles, not just on the stock market. I've written travel articles. I've written computer software review articles. Right? I have a son with autism, so I've written articles on autism. I have been writing for a long time. I was first professionally published when I was 14 years old. I sold a logic puzzle. I wrote to Dell Crosswords. Right? I like writing. I try and make it fun. But I also try and make it systematic so that my students can have expectations. Right? Every week, I pick the watch list, the stocks that have the best math, and I look at a move from the previous week, right, pretty much in hindsight, for educational purposes, saying, hey, this will happen again. Every week I pick 5, give or take, setups, and I talk about them in detail. Every week I review, and every week I educate. Right? And so we want to give you an opportunity to become a student. Right? Now, I am going to answer every question, or every question I can answer in the amount of time, but I want to give you guys an opportunity to become a student, right? To get the books, to get the videos, to get the newsletter. And I say that there's why do you want to become my student? Why do you want to join my family, right? And Steve and I have a really good relationship because he's teaching people technical analysis, right? He's making students better timers of the market, and I'm making them better option traders, right? And as an options trader, how much do you use, right? I showed you a student that bought 20 contracts at 60 cents. Well, if you don't have that much money, you can buy 10 contracts. You can buy 5 contracts. You can buy 2, 3. You can buy 1 contract, right? We will find setups that you'll risk less than the commission. Right? So with an option, you can't ever lose more than you pay for the option. Now, this is what it takes in a sense, right? This is how you become a good trader. What it takes to become a good trader, you have to be decisive. You have to be able to take a calculated risk. Right? And so my system, right, has a full money back guarantee. So what's the calculated risk? 0. What's it take to do? You got to sign up. How do you sign up? You click on this link, right? Somebody in Steve's group will make this link available, right? So you don't have to copy it down, so you'll be able to just click on it, right? If you're decisive and know that you can take action, right, with a calculated risk, and again, my risk is nothing in a sense. And here we have a full money back guarantee. Now, this full money back guarantee is probably written in a way that's a little confusing. So let me tell you exactly what it is. We guarantee that you can double your money 20 times in 20 days. Right? If you can't do it for whatever reason, such as you don't even try, you can ask for your money back. No questions asked. I'll give you your money back. Right? Here's the thing. I'm not saying you're going to put in $100 and turn it into $200 and turn it into $200 into $400 into $400 into $800 and $800 into $1,600, the $1,600 into $3,200, the $3,200 into $6,400, the $6,400 into $12,000, and then right 24,000 and 48,000 and 96,000. That's not what I'm saying. I want to make sure everybody understands. I'm saying that I'll present you opportunities that you can buy an option, right? Let's say it's $10, it'll go to 20, right? Or 100, it'll go to 200, right? I will show you at least 20 in 20 days that you can double your money on. I'm not saying I'm going to be right 100% of the time, so don't parlay this up get it to where it's $250,000 and then double down and lose it, right? My guarantee is if you can't do it for whatever reason, including you don't even try, right, I'll give you your money back. So I basically say to you, you got to be decisive. If you can take action here, knowing that's a calculated risk, you're risking your time, not your money. Understand a couple things here. I do not have a loss leader, right? This newsletter, you get the book, you get the videos, you get 3 months of my newsletter for $97. We don't automatically jump up to $397 or $297, right? It's $97 a quarter. You can be on automatic renewal. I never mess around with prices. There's no loss leader, and there's no discounts, right? There's no discounts. Having said that, I do want to give you a reason to join today, right? I filmed a video for a different publisher. Now, I want everybody to understand a couple of things. I do not self-publish this newsletter, right? I have a publisher that publishes it. Right? I get a royalty for doing this. I also get students sending me emails saying, hey, look at this setup here. You know, what do you think of it? And it's like, thank you very much. You know, you paid my mortgage today. So I get the advantage of having, you know, hundreds of eyes looking out for me. But I have publishers, and I made a video for a different publisher called Polarity Trading. And this publisher sold this video for $149, right? Physical video you get in the mail for $149. And this second publisher here has decided he wants to send any videos that people buy, send them a link so they can download it as opposed to sticking it in the mail. So he made his leftover inventory of videos available, and my publisher of the Pulse newsletter bought them all, and instead of him selling them at $149, he's giving them away. Right? He's giving them away as part of this program. So, having said that, if you can be decisive, right, taking a calculated risk. So, I'm going to look at the questions now. Now, I'm going to go back a little bit. I'm going to scroll back, so I'm not going to necessarily answer the first ones first. Some people asked some stuff. I kind of was looking as I was going out of the corner of my eye. All right. Some of these questions I'm looking at probably meant more as I was saying something. Again, I felt like a lot of the questions I might have been able to answer later on in the presentation. So I'm getting to the point where a guy says, do you favor high dollar stocks? You know, we hit FCX real regular, right? FCX is Freeport-McMoRan. Freeport-McMoRan's under $20. Right? Last week, we hit some Apple put options. Apple's about $120. Right? I trade Schlumberger real regularly. Schlumberger is just under $90. Right? We're looking for stocks that have certain requirements. One, you know, we want the stock to have weekly options. Now, understand, weekly options were an experiment about 10 years ago, but they officially came out in June of 2010. They came out with 24 stocks, and every week they might change the 24 stocks. So you might say, oh, I'm going to trade Las Vegas Sands this week, and then the next week it's gone. The program has expanded, so it's not only just 1 week, but they have like 5 weeks of expirations. So you can be buying weekly options all the way to the beginning of April right now, right? And we find stocks that we trade over and over again. Las Vegas Sands is a great example, right? We tend to buy out of the money options. We want to buy an option that's out of the money when we buy it, that's in the money when we sell it, right? Because that's where we get the most leverage. That's where we get these big, huge gains, right? How successful are your picks? I'm going to tell you something. When I buy a straddle or strangle, I'm rarely better than 50%. But our moves are so big, you can be wrong that often. Someone said, what the historic option prices, where do they come from? As a general rule, that stuff's from Yahoo. I do have some of my students here. I appreciate it. Someone said, what broker will accept 500 to open and be able to trade options? Right? Again, a couple things. I trade a fairly large account. I've been doing this a while, and so things can change. The key, most brokers will not open a margin account for less than $2,000. So you got to ask them about opening a cash account. And there's probably a half dozen or more that if you say, hey, I want to open a cash account and trade options, right? You'll find them that way. You got to ask the right question. Someone says, you didn't show any losers. Yeah, I showed losers. Again, when we buy a straddle or a strangle, we're buying a call and a put. And if the call works and the put doesn't, right? I have a fairly good track record. I don't know what it is. I have an assistant that keeps track of it. I just know that I make money. I know that my students make money. Again, here's the bottom line. If you take the course, right, $97, we'll send you the videos. If you're not happy within 20 days, send it back. We'll give you your money back. Someone asked, hey, can I buy just the videos? If you're already a subscriber and there's some new things here, this new video, you can just order it and we'll extend your subscription, and then you can get these videos as well. Someone asked, can you skip the auto renewal? Absolutely. All right. Someone said something about VXX. I'm going to be giving, for my students, in a week and a half, I'm going to be giving a whole webinar on trading VXX. Right? In addition to the newsletter, I do videos occasionally so that people can learn how to trade specific stocks. Someone says it's better to buy in-the-money options so you avoid theta decay. Let me tell you something. When we buy an option, we'll buy an option tomorrow morning that will expire later the day, right? There's little theta decay because there's little time value left, right? I think I will put my math up and my students' results against anybody. It's an assumption on people's part from historically having used options as a stock substitute to buy in-the-money options. I will back my math up. Occasionally we buy in the money, but as a general rule, we buy out of the money. Right, someone said, $97 a quarter is their startup cost? No, $97 will get you these videos, get you the bonus videos, and a 3-month subscription. Right, free trial. Buy it. If you don't like it, you had a 20-day free trial. All right. I'm losing my voice. I got to take a drink here. I've spoken for a little over an hour. maybe ask Steve or Becky to come save me. Again, $97 a quarter. I don't raise my prices. Having said that, if I ever do raise my price, you will be grandfathered in. I think it's a very good bargain. I got to tell you something. I'm big into statistics. My publisher publishes lots of authors. I have the highest retention rate of students, right? They call them subscribers. I call you students. I have the highest retention rate of students of any author of my publisher, right? Someone said they had a, you know, if you got a problem, email me. We will fix the problem. Bottom line, you make this stuff work. Steve's not going to have me on here if two things. If we're not the real deal, right, in terms of the product, and a real deal in terms of our guarantee. So. Anyway, again, I'm going to call out Steve or Becky. I'm losing my voice here. Again, if you have a chance, if you can go look at live option prices, go look at the VXX, today's VXX 30.5, 31, and 31.5 puts. Look at the opening price of those and look at the closing price of those. If that doesn't sell, you know what? Again, we're doing a dedicated video, right? No sales, nothing, just a dedicated teaching video on VXX in a week and a half for my students. I would say get the material so you have a better understanding of what I'm talking about in the videos, because I'm going to make an assumption when I do that video. I'm assuming that students know a little bit of what I mean. So, Steve, I thought I heard you back there.
I'm here. Hello?
Yeah, I'm here.
Are you starting to lose your voice? Is that what's happening?
Just a wee bit. I get into this a little bit. You know what?
Okay.
I don't want to use the word proud of what I do, because I think pride is not necessarily a good thing. I believe in what I do. I believe in my trading system, and I believe in my educational system. I teach students how to make money. Right, Steve, you know that to be true. So.
Oh yes, yes. Yep.
And that's why we get along, because I know you believe in your product, and not just in the teaching methodology and the material you're teaching, and it works. Your students become better traders, so do mine, and they complement each other so well.
Okay, well, it sounds like you're starting to lose your voice. Do what I do. Take a shot of scotch. That always brings everything back. I'm just joking. One time I jokingly said on one of my sessions that when I was slurring or babbling my words, I said, "Oh, this is what you get for drinking so much before a session." And right afterwards, I had somebody email me saying, "I want to quit my membership because I don't want a drunk showing me what to do." And I had to email him back and said, I don't really drink at all. I just say that, but that didn't convince him.
I'm drinking vitamin water here, so.
All right. Yes, everybody, take a look at this system. I mean, this is not theoretic. This is somebody that actually trades it and is very successful at it. Not only successful at trading it, but, as I said, it's successful at showing other people how to use the same system. So this is why we have Chris educating people, because there is a sincere desire to not only make money ourselves, but if we give out our supposedly secrets or our little trading programs, there's a lot of people out there that says, "Oh, I'm not going to tell people what I'm going to do," but we're still such a microcosm of a total investment universe out there but I've discovered that the more you teach people what you're doing, the more it comes back to you, because I get so many good ideas or good situations coming back to me from people that I've taught, and it just gives me a broader community to talk to. And this is kind of the same criteria or same impression you get from Chris, is that he is out there showing people a different strategy because it works for him and he wants to show other people. So let's see, do we have do we have a link for people to get signed up with some of your programs? Oh, is that it? Okay.
Yeah.
Let's
I think
see.
Becky's input it into
Becky,
the chat.
do you have it? All right.
So,
all right. Well,
again,
we're not going to hold you up anymore. I know what it's like to start losing your voice. So I don't know whether you want to try to take questions at this time or not.
There's some stuff going by in the chat. You know, again, I think the bottom line, if a person can't be decisive and take calculated risk, they probably shouldn't be anybody's student. They shouldn't probably trade at all, because you have to pull the trigger when it comes to, you know, getting in. And I like to think of myself where I share how a put option, you know, is a bet the stock is going down, but a put option is also insurance that you can have if you own a stock in case it goes down. And I like to think that, you know, my system is a call option, metaphorically speaking, because it's got all this upside. Or it's like a stock with all sorts of upside, and then the money back guarantee is a put that it won't cost you anything. So, again, I enjoy writing. You guys will have some fun. You know, you got to get used to my sense of humor, though. So, anyway, Steve, again, I thank you so much for having me. I thank the audience for taking the time out of their evening, and for anybody that's listening to this, you know, a recording.
Well, thank you, Chris. And yes, this is good information, because we get a lot of requests of people, especially in the option trading room, of whether somebody in there trades weekly options, and this should be a good program for somebody to get involved with if they're in that trading in that area. And unfortunately, I can't see any of the questions coming across because my chat quit at 7:59 with Lady Trader from David. So with that, David, Becky, if you're putting Chris's link in there, everybody take a look at this. This is good information, and if it fits with your style of trading, this is the person you want to be involved with as far as getting the right trade setups. So let's call it quits from there, because my chat room is quit and your voice is quitting. So we might as well call it quits. Chris, thank you very much for your information. Everybody, take a look at Chris's stuff. This is why we have him on here, is because it's good common sense trading strategies. All right, with that, everybody, Chris, yep, thank you. And thank you, everybody. We'll see you in the chat rooms.
Steve, thank you. Good night.
Okay. Good night, Chris. Thanks.